The first quarter of the year has been characterized by much market volatility, uncertainty over the local and global economy, and we've also been seeing the local and global political risk factors that have certainly influenced the equity and bond markets. But let's discuss this further in terms of investment strategies in this current environment. I'm joined by Schalk Louw, Portfolio Manager at PSG, Nerina Visser, ETF Strategist and Adviser. Good afternoon to you both. Schalk, let's start with you there in Cape Town. Just taking a look at your latest column, you said that the JSE seems overvalued at these current levels. Talk us through your thinking.
Demisha, I think the easiest way for me to explain that article, besides the fact that I would encourage all the people watching this to go and read it, it's when I look at the equity market currently, I'm seeing a dog, and I'm not looking at that in a bad way. I'm actually looking at a dog walking with his owner on a leash. The dog being the equity prices, and the owner being the physical earnings they produce. Now, we all know, I mean, some countries like the Germans, German Shepherds, big dogs that walk straight, and I see us as a little Jack Russell running all over the place. Sometimes the share prices is way ahead of the earnings, sometimes they're behind. Currently, we're looking at, in our valuations, at a leash that is very long, and a dog that is running quite far ahead of the earnings. When we look at earnings, earnings currently is year on year, well, it's negative 14.5%, and we're still trading at the highest PE levels in 20 years. So it's not really adding up currently. So yeah, I think in short, you know, when you look at things like the earnings compared to bonds, your market cap currently, in relation to the GDP levels, we are trading at exuberant levels, and I would encourage everyone to just be a bit prudent.
Prudent. So that's the message to investors out there. Let's come back here to South Africa, to Johannesburg. It doesn't feel like South Africa. ETF SA had a report that they released this week, and they said that the best performing collective investment schemes for the period to end March have been passive ETFs and not actively managed unit trusts. Really? How come?
Yes, indeed. But when you look at the details of that, you'll see that it is a different ETF for different periods. So for example, for the 1 year period to the end of March, it was a resources ETF. When you look at the 3 to 5 years, it is the USA ETF. And when you look at 7 and 10 years, it is the Indy 25. So I think what's interesting to see in there, that we must remember that an ETF is really just an investment product. It's an investment vehicle. It's the underlying index that is being tracked by that ETF that really determines its performance. And if you are going to compare a particular within a sector or within a geographical region, yes, if you are comparing the passively managed investment, i.e. the ETF, with the equivalent actively managed unit trusts, the ETF always wins because of its much lower cost structure.
Schalk, let's come to you. Given the information that we've just received, if you were looking at your investment portfolio, would you say that it's better just to have passive ETFs?
Well, I think currently, I mean, when you look at the current market conditions, there's definitely a market. I mean, we personally, very positive on the ETF market. We've seen it grow immensely globally. And I think to a certain extent, although we've seen growth in South Africa, we're still very happy to see the growth in that market, because it's a definite market for ETFs, especially if you look at, over the last, let's call it 12 months, we've had the discussion over commodities. People really been scarce and underweight, and in some instances really no weighting in their portfolios in commodities. And those actively managed funds are now really underperforming things like the ETFs. We don't have a choice. They have to have that weighting in things like commodities.
Nerina, let's look at the retail investor here. There are a lot of options when it comes to ETFs. Yeah. So what are some of the factors they need to consider before they start looking at the type of ETF that they should be choosing?
I think what we need to understand is an active decision is required irrespective of what you invest in. So whether you are actively choosing an actively managed fund, or whether you are actively choosing a passively investment fund like an ETF, yes, there's still a choice to be made. So the investor needs to first and foremost appreciate what type of active decision am I comfortable to make myself, and what type of decision do I need to a professional, either my advisor or the fund manager. And what we clearly see is that within single asset class funds, so within equities or even within industrial shares, the ETF, the passively managed vehicle, always trumps the actively managed fund because of the cost differential. What you need to ask yourself is, what is the value that an actively managed fund that can correctly allocate to the different asset classes, what can that bring to the table? And that, I think, is quite a different argument or a different discussion compared to just selecting a top 40 or an all-share fund, or even a resources fund for that matter. But even within the so-called balanced fund space, where the majority of retail investor money flows into the balanced fund space, there's huge divergence in terms of what those asset allocation decisions are that the active manager makes. And one of the biggest concerns around the actively managed fund is that you've got so little transparency in terms of how is that active managed fund being exposed. You only ever find out after the fact, and often by then it's too late to make a decision. And for the retail investor, it's very, very difficult to correctly identify in advance which will be the active manager that will provide the relative outperformance. So a lot more relevant is really, what are you trying to achieve with your investments, and identify an investment vehicle or an investment solution that is consistent with your goal, what you're trying to achieve with your investments, rather than the sort of rearview mirror, hindsight driving, always looking at what was the best performer over the last year or 5 years or 10 years, and then blindly going into such an investment vehicle.
Schalk, let's come back to you. Of course, we are still discussing investment strategies. We've looked at ETFs, but I think another hot topic has been offshore investing. We've looked at where where the dollar rand's been sitting. Apparently, looking at the data that's come out from the South African Reserve Bank over the last 16 quarters, we've seen net outflows. So we've been seeing a lot of investors putting their money offshore. So, with that said, should we be going offshore? Is this the time to do it?
Demisha, I think, and I'm going to create some controversy again. We had this conversation earlier this year about commodities, with us feeling that commodities was a little bit oversold. I think currently, when I look at my models on the rand itself, and I want to encourage you, I did a report on it which is going to publish next week. If you look at the rand, we've seen excessive movements, and there's a lot of people that says it's justified. Now, I took 3 indicators next week where I look at things like, for instance, the first one is when you look at purchasing power parity, and we just take over the past 20 years, the premium which has been trading above, the average premium it's been trading, is about 42%. When you look at that 42%, you get a fair value on the rand of about 11 rand. Now, I know there's a lot of people that feel that the rand is better priced at 14.50 rand, and I'm going to say yes, 14.50 is better than 16.50 when you have to do an offshore investment. I do, however, feel that currently, at current levels, the rand is not cheap, not overvalued. It's actually still on the cheaper side. And when you compare it, for instance, to the commodity index, we've seen a drop 60% since 2010 in commodity prices in dollar terms, and we've seen the rand depreciated by 60%. So if you have the view that commodities sort of bottomed out, I would be very, very careful to bet the farm and take all my money offshore now. Just be very, very prudent in that regard as well.
We have to wrap it up, but I just want to get a very quick comment from you, Nerina. The director saying we have to wrap, so about 10 seconds. What do you think about offshore investing?
I think the interesting thing is to see what is the international investor doing. And the international investor is coming into not just South Africa, but emerging markets in a big way. So this is for me I agree with Schalk, but this is not just about the commodity cycle. This is very much about the direction of flow of international investors, and they are buying emerging markets and South Africa. So don't rush to take your money offshore.
You've heard it. Don't rush to take your money offshore. And of course, you also heard what Schalk had to say, saying looking at the JSE, it does seem a little expensive. That was Schalk Louw, portfolio manager at PSG, and Nerina Visser, ETF strategist and advisor.